All right. So today, what we're going to go through is what I'm calling the 7 foundational strategies to investing in commercial real estate. And this kind of came about through a conversation with a friend who's interested in investing in commercial real estate. And he was asking me some really good questions. And it got me to thinking in terms of like, okay, like, how do I distill this down? Like, what are the things that worked really well for me? And what are the things that, looking back, I would have done differently? And so I typed it up, and actually, this is part of a free training that I'll be giving to anybody that is kind of on my email list. I'll talk more about that at the end. So let's get into it. Now, okay, number one, market cycles, buying in a recession. So this is probably one of the things that I witnessed most, which is like really buying properties when sellers need to sell. I've never been a fan of having to be in competitive offers. Doesn't mean that you only buy in recessions. Like I've bought all through hot markets, up, down markets, all the rest of it. But I'm always looking for a few things. One, I don't want to compete, which means I'm usually going off market or going direct. And two is I don't like to be competing against other buyers because that just usually pushes the price up. And the person that wins, generally, not always, is the person that's paying more. Although there are some strategies on how to get it even for cheaper. Number two is value add. So I'm always looking for properties where I can add some value, especially when you're raising capital. This was I remember having a conversation with a prospective investor that was going to put a lot of money into one of my deals, and he just asked me point blank, like, "What are you doing?" Right? Like, I could invest in Boardwalk, I could invest in Main Street, I could go to, a whole host of other places to put my money. So why am I giving it to you? And now it's much easier because I'm a developer, and so I'm taking raw land and actually building something. So obviously I'm adding, a lot more value than just a value add. However, if I was just starting, that would be the next biggest thing. Number three is selling. I've made this mistake, and I'll get more into it in the second part of this video/podcast. And that is when the market, like, as markets ebb and flow, when you get to the top of a market, if a property is not a property you plan to keep for generations, or whatever your strategy is for that specific property. So I'll give you a really good example. I bought an apartment building, and the strategy was we're going to add value, raise the rents, and I didn't have a clear exit, right? I didn't actually understand that we could do it so quickly, and it was going to be part of a bigger portfolio, but we never actually completed the portfolio. And what ended up happening was we went through the up market, it came down, and then it remained low for 7 years. Okay. So just having that clarity on, and I'm not making that mistake again. I can tell you that right now. I've got a couple properties that I have interested buyers, and because I don't get too emotionally invested in them, if the right number comes through, then we'll sell them. Number four is specialization. This is probably one of the other big mistakes that I made, which was going from, I was really starting to learn and master multifamily. Then it went into mobile homes, then into retail, then into industrial. And at every stage, you're having to relearn. And it's exciting and it's nice because you're always feeling like you're growing. However, to go up against someone that has been in, say, multifamily for 25 years, and you've only been at it for 3 years, you might be able to compete, but they're just going to have an edge on you. And so I would certainly stay away from being a generalist, and I would be focused on really mastering one asset class. Next is having capital to take advantage of opportunities and move fast. I can tell you pretty much without question, especially when you're small, right? So I'm talking to most, let's call it, private investors. Obviously, if you're an institutional investor, it's unlikely you're going to be able to move as quick as someone smaller because there's just multiple people that have to weigh in on an investing decision. And so that is one of the advantages, if you will. So A, if you have capital and you can make decisions quickly, that's how you compete against some of the players that are more well capitalized. Number 6 is avoiding a single point of failure. And so I'll tell a story here in a second, but essentially what that means is having one tenant, or let's say you require low interest rates for the deal to work. I mean, you want to move away from anything where one thing can actually take you out of the deal. And number 7, commercial real estate is all about debt. And so, as you can probably see right now, if you're in the market and you're trying to secure debt, it is, I would estimate, 2 to 3 times harder today to get financing than it was 2 or 3 years ago. Okay, so that's just a reality that we have to that we're in, and it's also like, if it goes back to having that capital and being able to deploy it and take advantage of opportunities, right? Because if debt is harder, that means anybody that has capital or the ability to raise capital is going to be able to take advantage of those opportunities. So those are kind of like the 7 things that I look at. Now, if all you do is you invert those 7 and you say, like, if you avoid those 7, that's where I would say 95% of the mistakes I've made and seen others make would fall under those. So I'll give you the examples here, because I think these are probably even more relevant and they drive home the points much better, because what I just told you might seem like common sense, but then when you hear the inverse, I think it'll just have a little more, I think it'll be more helpful. Okay, so market cycles, buying at the top of the market, excuse me, when everyone else is buying. I mean, this sounds so obvious. However, I can tell you over the past like 3 or 4 years, like when I was coaching, I don't do that anymore, but when I was coaching and when I was talking to a lot of investors on a frequent basis, I was shocked at how they were competing, how the extremely low cap rates. I mean, they were just chasing deals, and I was constantly reinforcing the idea of just being patient and finding opportunities, not being in a hurry to acquire something. Okay. And so, like you saw it, I mean, it was just a huge run up of investors that all wanted to get into commercial, multifamily, self-storage, whatever it happens to be. I think that is starting to dwindle, but the smart people are saying, you know what, this is where the real opportunities are going to come about. Okay. Number 2, buying properties where there is no value add, right? Like essentially just buying what I call coupon clippers. I'm not even going to go into anything else on that. Number 3 is not selling when the property should be sold. Okay, so the multifamily that I shared with you earlier, had I taken advantage back in 2014, I think it was, I would have probably capitalized and made about $500,000, which would have been about a 50 or 60% return in about 2 years. I didn't. I held it, got my head kicked in for the last 8 years on that property, and we will take a loss. It'll be a small loss, but if you factor in how much effort, time, energy, all the rest of it that went into managing that property over the past 8 years, I mean, the money is one thing, but you don't get that time back and that effort that goes into that type of a property. So if I could just reinforce the idea of just having a really clear plan when you buy a property, and if you know that you're going to sell it in 2 years, don't put 10-year money on it. That would be the other kind of mistake. Number 4, being a generalist. So for me, when I started, I was across Canada. I was into the US. I was buying apartments. Like I said, we were buying distressed debt. We bought mobile home parks. We bought industrial, retail, ground up. And it was fun. I wouldn't trade it because it gave me a very broad foundation. And now I'm able to basically say, okay, this is why I'm in this asset class at this time. Okay. However, if you could avoid that, I think that would be, that would give you a significant advantage. Number 5, having no capital or moving slow. I'd say probably the biggest miss that I ever had was on a multifamily property down in the U.S. I made an offer on it. It was about $20 million. There was a gentleman that said he was going to finance and back me on this particular property. He ended up being, I'll just say, a flake. Like he essentially just fabricated everything. He talked a good game, and frankly, I bought into it. But this is before I was able to. I wasn't very established, right? I was good at one thing, which was kind of hunting, hunting and finding properties. I wasn't good at raising money back then, and so I ended up having to take that deal, and I sold it to another buyer. They did extremely well. They probably made $13 to $15 million on that property, as well as that just got them into the game, and they did extremely well. So I look back at that and say, like, what was the mistake? And the mistake was I didn't understand how to raise money, and I didn't understand like who to trust. And I don't know if you could like necessarily buy a course, read a book on that. I mean, a lot of that's just going to come from business acumen, reading people, and experience. Number 6 is having a single point of failure. So I'll tell you a quick story on this. We had a retail development where we had one tenant, 1,200 square feet. They were not an anchor tenant. I mean, we had the thing buttoned up, but in order to trigger our phase 2 of the debt, we needed to hit, I think it was 80% leasing. And this one tenant would go from like 77.5 up to 88% or whatever the number was. And our bank at the time, I'm not even going to say who the bank was because it was a very, very frustrating experience with me. They're one of the big 5. They wouldn't budge. And so we basically had to bend over backwards for this one tenant. 1,200 square feet, ridiculous. The amount of terms, what we gave this individual, I would never do it again. I would never put myself in that situation. And that's what I call a single point of failure, is just having that one tenant that had so much friggin' leverage on you that they are able to drive the terms to a point that really don't make sense as a developer. And then number 7 is, right now, like I mentioned, in terms of commercial real estate and where the debt market is. So if you can see where debt is going, and the fact that it's going to be more difficult to finance, especially on commercial properties. On residential, it doesn't seem to be the same risks, if you will. However, if you are buying like retail, like office for sure, probably less so on industrial. I mean, the interest rates are much higher, which means you're probably going to have much lower loan to values, which means you're going to need more capital, right? So if you have 5 and 7 together, 5 is having access to capital, and 7 being the fact that you just know debt is going to be harder to come by. I feel that this is where it starts to move back into a buyer's market, right? So back into number 1, a market cycle. So when it's a buyer's market or there's less competition, this is really where I think you're going to see some smart individuals take advantage and do well. So hopefully that's helpful. Like I said, this has been just kind of really reflecting on what it was that helped me to invest, and I thought I would share it with you. All right, that's it for now. See you next week.